Hello, team. Did you enjoy your morning tea? Yes. I had one of our presenters go and get me an extra plate of goodies, so I was eternally grateful for that. To all of you who've joined us online, it's lovely to have your company. Fantastic. Share the love around, share the link, and let more people know what we are up to. We're going to start this session off with a bit of an educational for us all. So, as we know, Wilsons is a predominant sponsor of us here this year, so we have one of their esteemed members coming up to join us. Did I say to you before we went to morning tea that I'd actually... because I'm a bit of a nerd, I'd listened to a fourth podcast this morning? I did. It was only 10 minutes long, so that was okay. That was Invest It Best. So that is a podcast that the team do at Wilsons. And if you want to learn more about investing, it's a really good one to listen to yourself or advise other people to have a listen to. It's really good. So one of the experts that is often on this particular podcast is the fellow that stands in front of us here, this baby-faced young gentleman here, who belies his depth of knowledge. This is James Karakatsanis, and he is our keynote speaker for this year, for 2024. So I'd like you please to make him very welcome as he talks about the oil and gas tailwinds.
Thank you very much. Thanks for the opportunity to have me speak as the keynote speaker today. We're going to touch on a few little aspects, or which turn out to be probably big aspects, that are really driving our thoughts around why we think the oil market is going to be experiencing tailwinds over the next short to medium term. We're going to start off having a look at global oil consumption, and we're going to compare that with population growth and GDP growth. So across the world, we're seeing over the past 40 years, there's been consistent growth in global oil consumption, and there's been a near perfect correlation, as you can see on the chart on the left. There's been a couple of little blips there in 2008, 2009, where we obviously had the GFC, and most recently with COVID, where we saw about a 10% reduction in global oil demand. On the right-hand side, we've got global consumption plotted up against GDP per capita again, and as we can see, as economies grow, as we move from low to middle to upper class, the GDP is growing, and the demand for oil is growing as a result. So this is really a 10,000-foot view of the industry. If you've got the view that population growth globally is going to continue, and that GDP is also going to grow, then you should be expecting more oil demand going forward, at least into the medium term. Now, just as a reminder, and it's quite a heavy mining focus at this conference, but from the energy side, the pie chart on the left, top left, you can see that oil goes into a whole bunch of different things. Obviously, it runs most of our cars, trucks, goes into petrochemicals, synthetics, things in your clothes, plastics. Almost every product either touches or uses oil to some extent, or actually has oil products in it. Now, the really interesting thing that's happening since the early 1990s, we've seen that OECD, if we look at the chart top right corner, we break out global oil demand by non-OECD countries and OECD countries. And we also plot that against the WTI curve there that's orange. And in the early 1990s, we can see that OECD demand actually were the major consumers of oil globally. That's changed. As of 10 or 15 years ago, you can see that the curves cross over, and now the non-OECD countries are the largest consumers of oil globally. Why does that matter, and why do we care? If you have a look at non-OECD growth during that period, oil prices were hitting $130, $140 in 2008, $100 during 2010 to 2014. And the non-OECD countries did not falter in their demand. In fact, they continued to grow their oil consumption. So that means that their demand is largely inelastic. And Daniel Yergin, one of the global energy experts, said that reality is stubborn. And I think the non-OECD countries are the most stubborn oil buyers or purchasers to date. When we have a look at global population, you can see that non-OECD, so on the bottom right corner, the non-OECD countries are actually rapidly increasing their population, whereas the OECD countries have been slowly growing in population. So when we think about demand, I know there's a lot of conjecture out there around demand peaking out in 3 years or 5 years, and we think that that's probably unlikely, and the reason is that these thematics they sort of come and go. You probably recall peak oil was one of the biggest thematics 20 plus years ago, and this one I feel is not too different, although it does have some reasons behind why people believe in that thematic. So if we look at 4 countries that constitute a little over 40% of the world's population, that's China, India, Brazil, and Indonesia, they currently consume, well, if we look at consumption per capita, if you look at the top right little dots there, that's the US and Australia on a per capita basis consumption, and on the x-axis is GDP per capita. So as the nations get more wealthy, they're going to be consuming more oil. If we assume $50 is, 50 barrels per 1,000 people per day, which is a proxy for consumption, is what we consume on average as a developed nation. So this is just a proxy. We consume 10 times more than India or Indonesia on a per capita basis, and we consume 5 times more than China and Brazil. So the running room is absolutely massive and completely understated. So if we shift to global oil supply, in the green bars we've got global upstream investment, and in the orange we've got WTI, just the oil price. We can see that they've been tracking along together as the oil price drops, investment in the upstream sector drops accordingly. When we think about investment in the global oil industry, we need to make an assumption around what a balanced market looks like. What sort of oil price can we expect when producers are making sufficient margins and purchasers or buyers are able to use those products and still make their own margins? And so we assume $70 for that. And so that's the horizontal line there at $70. We can see with those arrows is that there's about $1.14 trillion of underinvestment in the industry since 2016. And there's 2 main drivers. The first one, given this is a resource conference, people are well aware that there's the commodity investment cycle. As the commodity moves around, the investments move around too. And that's about 650 billion. But what's quite interesting in 2020 to today, actually, it's those red arrows, that we're seeing a dislocation of this long-term trend. So money's been moving away from oil and gas companies and into renewable type projects, alternative energy sources. Companies are prioritising buybacks and cash returns of some sort. And the oil industry is really missing out on that capital. Now, when we think about supply globally, on the chart on the right, you've got to think about breaking it out into OPEC and non-OPEC. And OPEC obviously are a cartel, a consortium of many countries that make decisions around whether they should be adding or taking off barrels from the market, and they might meet every quarter or every half. So what we've seen since 2008 is that non-OPEC consumption, or well, in this case it's we're talking about supply, but it's the same thing, is that it's been relatively flat. The growth there in consumption is effectively has been de minimis in the non-OPEC countries, except for the US oil shales and the Canadian oil sands. And so we'll talk about that in just a second. The Canadian oil sands have been slowing in growth materially. They're pretty challenging from an environmental standpoint. They've got relatively high break-even costs. So we're not expecting much growth there. So it really comes down to the US shales. They've been the only and largest global incremental growth in oil supply over the past 10 years. So we need to really zoom in and think about the US shales if we're thinking about supply and demand. So over the past 10 years, it's increased around 8.5 million barrels of oil a day. The chart on the right is the culmination of each of the regions, but the charts on the left in green demonstrate that some of these regions are actually experiencing resource depletion. So these are production rates over time, and you can see that they're following a bell curve. And what that means is once there's different tiers of resource, once the top tier is largely depleted, then production rates seem to fall off as they move to tier 2 and tier 3 resources. So what does that mean in terms of oil supply? If this is the only global incremental material growth in oil supply, and there's other places around the world that are experiencing growth, such as Namibia and Guyana. But overall, if you look at the world on a balance, it's still really struggling to bring non-OPEC growth to the world. So what's going to happen? And if we refer back to the previous slide, and since 2008, as I mentioned, the non-OPEC growth's been effectively flat. Is that with time, non-OPEC, as the US shales plateau in the next 12 to 24 months is what we're expecting, we're really struggling to come to the realisation or understand where non-OPEC growth is coming from. So what happens is market share will move away from the non-OPEC countries and move to OPEC. And as OPEC increase their market share, they increase their pricing power over the commodity. And that's a major trend that we're expecting to play out over the medium term. Thank you very much. I might just quickly say thank you for Vertical Events and the Marriott for all the support over the last couple of days, and the companies and investors here. You guys make the event 2 days over one roof. It's a great outcome, and obviously Wilson's for their sponsorship and support. And we've also we've got a few members here. So Craig Brown and the team have raised a little over 200 million over the last year and a half. So we're very active in the space, and we're happy to chat to people. So don't be shy.
Do you want to get them to stand up? I
Yeah,
think you should.
sure, why not?
You've got 1 minute and 58 seconds. We need some light. Come on, up you get. If you're involved with Wilson's, up you stand.
There we
All
go.
right. Thanks, guys. Right. So do you enjoy that?
That was good, yeah.
What are you going to talk about next time?
I might have to talk about the energy transition, I think.
Okay, that's
Yeah.
fair. So how often do you do the podcast that's on the site?
Well, Ted Richards runs that.
Yeah.
He probably puts out a podcast every month
Yeah.
for us. So, obviously I was on the most recent one.
Yeah.
So that's been good. It's been generating a little bit of interest and conversation in a whole bunch of different sectors.
I think it's a really good idea because a lot of you, obviously, in the room have got a lot of experience in this industry and you've been investing for a long time. And then there's other people like me who started off investing in houses and only just really starting to get into investing in resources. And it's really nice to have that sort of a resource for us to refer back to. I mean, one of the questions that was asked this morning was for someone to explain an acronym. And it's nice that we've got an environment here where we feel that we can ask these questions and we're all going to support one another. But to be able to take that in our palm of our hand and wander around with it and have that information and learn online, it's a great idea. So kudos to you and the team for putting that together for us. We appreciate it very much.
Thank you.
Thank you very much. All right. All right, team. Now, this fella at the back, where is he? Is he on the side now? He's already here. He's raced up the front. So we're going to go to a company now which is focusing on near-term growth and regional exploration. The company is Alto Metals, and we're headed west. We're going to my state, my home state, WA. The project is actually called Sandstone, and the interesting thing about Sandstone, there's a couple of interesting things. One, it's neighbours. It's got some $1 million, I say $1 million, it sounds like real estate in the Gold Coast, doesn't it? But it's got these really impressive 1 million ounce neighbours, and we all love a little bit of rich neurology. And the project itself, historically, has already had, was it 1 million ounces already out of the, so 1 million ounces already out of this project. So this fellow here, Matthew Bowles, is their MD, he's the man in charge, and he's going to convince you that you should be involved in this project and as passionate about it as he is. Please make him very welcome.
Thanks, Chrissy. Hi, everyone. It's great to be here. And it's the best place to go and find gold is where gold's already been found. So I'm going to tell you a little bit about Alto Metals and our Sandstone Gold Project in Western Australia, which we're obviously really excited about. Sandstone's had a long history of mining, as Chrissy alluded to, and there's a number of historical old pits there. And the image on the front you're looking at there is one of those, one example of a number of 3 or 4 other pits. It's a open pit, was mined down, just oxide mineralisation, and as soon as they hit fresh rock, they stopped mining. So it's a very small mill. So that was mined about 20, 30 years ago. So a lot of the history that we've had there has been just focused on these sort of shallow oxide pits, and when we started drilling a lot below them and finding a lot more gold, and it's growing the resource, and I'll talk about that now. So just quickly, that's a disclaimer to read. So we're an advanced West Australian gold explorer. We've got a strategic ground position of over 740 square kilometres and over the Sandstone Greenstone Belt in the East Murchison. So we're surrounded by a number of multi-million ounce deposits, operating mills, so it's a fantastic spot to be. We've got optionality over toll treating or standalone and developing it ourselves. Our resource at the moment is very good. It's of 832,000 ounces at 1.5 grams per tonne. It's very, very shallow. And we can see significant exploration upside here. We've really only just started scratching the surface. We've been adding ounces pretty rapidly. And this is continues to be our focus of growing those ounces. So the strategy at the moment is focused on near-term growth and I guess that higher regional, higher risk, higher return regional exploration, which I'll go into. So very, very quickly, on the market cap side, so we've got about just over 720 million shares on issue. Share price is about 3.4, so our market cap sitting about $24 million. So that equates to an EV per resource ounce of just over $20. And when you think of where the gold price is at the moment, and typically the peers, and it obviously depends on which peer group companies you include or exclude, but the peer average is sitting around 40 to 50, so we're well below our peers at the moment as well, so I think represents a really good value. This is the image, so you can see here in the blue is our tenement outline. It's sitting over that whole Sandstone Greenstone Belt. And you can see out to the west there, I'm sure you're familiar with Ramelius. So Ramelius have got their Checkers mill out that way. There's a sealed road that runs all the way through our property to Checkers, and then over to the east is Goldfields Agnew deposit. So 2 key deposits there, and then further to the northwest is Westgold's operation. So obviously Ramelius and Westgold are in the paper quite a bit at the moment. Quite a lot of rumours happening around M&A, and I think there's starting to be quite a lot more activity happening in the broader region and across the whole gold space as well. So getting to Sandstone is fantastic. You can drive up there. It's about an 8-hour drive from Perth. You can fly out. There's a landing strip there. It takes about an hour, so we take broker trips up there quite often. So it's really, really accessible. We've got a couple of houses in the town, and I said we've sort of developing that project quite quickly. So we put out a resource update last year, and the key things to note about this resource, that 832,000 ounces, it's optimised within, it's pit constrained and optimised. And that means that we've sort of used a $2,500 gold price and we've put mining parameters around it. So it's a very robust resource. It's all very shallow, so 90% of that resource is less than 150 metres from surface. It's good grade at 1.5 grams per tonne. And importantly, when you're looking, I guess when you're going through and screening a lot of your gold stories that you may be following, we've undertaken quite a lot of metallurgical test work. And that met work's important for determining whether something's refractory or non-refractory. And from what we've seen, our recoveries are up to 98%. So no indication of refractory at this point. And the gold can be recovered through a very simple CIL process, which both the mills at Ramelius and Agnew are, but we're focusing again on that standalone and trying to grow that resource rapidly to get to support a standalone position. And this is a great example of that resource growth, and there's two things I want you to take away from this slide. One is between 2018, 19 and 20, the company was subject to a number of takeover offers, and that really did hamper us from getting out there and hitting the ground really hard. It's difficult to raise money when you've got bids and so forth, and there's various other factors in place. So it really sort of hamstrung the company, and we did miss out on quite a strong gold run in that junior space a few years ago. But as you can see, when those bids sort of were defended and sort of fell away, well, there's always a bit of noise there, you can see the two grey charts shows the drilling that we did in the subsequent couple of years. 60,000 ounces followed by 50,000 ounces. And you can see that resource grew very rapidly. And that's why we were very confident that this resource is really only constrained by drilling. And we're looking at sort of having another resource upgrade later this year, and I'll talk about that shortly. So if we just zoom in on our project, and the challenge with sandstone is there's because it's had such a long history of mining, and there are a number of resources and small deposits there, how you prioritise and sort of focus those areas. And the reason we initially went to the southeast of the project, which is where we're calling this our alpha domain, is that's because that's where all of our resources are. So initially it was stepping out, drilling below some old pits and stepping out and chasing a long strike, and we were adding some ounces there. And we did that down at the Lords in the bottom right-hand corner of the slide there. So Lord Nelson, Lord Henry, it's a granodiorite intrusion, and it hosts two oxide open pits. As I said, so we've drilled below that, grown that resource to 400,000 ounces in that camp. We then moved up to Vanguard, which has a number of historical old shafts, old timer shafts, so these guys were going down and sort of mining out sort of 34 gram plus material. So we've sort of grown that resource from 50,000 ounces to 150,000 ounces. That resource is still open along strike on northwest trend and at depth. It also hosts our highest grade deposit at Vanguard North, and we put out a release the other day that we've seen a soil anomaly just to the north of Vanguard North, which looks like a lookalike, so that's pretty exciting for us. If we move further up that corridor, we then get to Indomitable, and Indomitable's huge. It's got an oxide footprint at the moment, which we believe is an indication of something much larger at depth, but it's defined over 3.5 kilometres, so we've got mineralised footprint over 3.5 k's. It's open in all directions. We put out some fantastic drill results last year, sort of 27 metres at 7 grams per tonne, very nice and shallow. And the more that we keep drilling Indomitable, we just keep finding a lot more gold, and we can see that growing quite rapidly. And then we move to the very top of the corner point, and to Bull Oak, which was the image on the front. And this is what I want to talk about today, and where we can see some considerable growth here. So Bull Oak, as I said, that was mined during the quite a few years ago. Again, just mined out the oxide. They hit fresh rock. They stopped mining. So we drilled a very small program last year. There were a couple of old WMC holes that were drilled. It was WMC and Troy Resources, and they both hit about 240, 50 metres at about 0.6, 0.7. So big broad zones of mineralisation, and within those zones there was some very high grade, up to 18 to 20 grams per tonne. So a number of stacked loads within there. So we sat down with our resource consultants, and we decided to sort of test how big that strike could be, and we sort of did some big step out holes, sort of 80 metres from both of those holes. And those holes both came back with over 160 to 200 metres of mineralisation, again running at 0.6 to 0.5, but within that some very, very high grade. The key thing about this is it'll bulk out, is what we believe. And the other part of it is, from what we saw at the time, the mineralisation was just constrained to within that granodiorite, so it's 400 metre long by about 150, 200 metres wide. The step-out holes also tested outside that granodiorite, and we hit more mineralisation. So that's quite exciting. So it's telling us that the mineralisation is not just constrained to within the granodiorite. And also within that, you're getting some very, very high-grade reefs. There's the, I can never pronounce the second one, but bear with me. There's the Koh-i-Noor, the Fal-Balar, so I apologise to any Irish people here, and then the Bull Oak Reef. So they were both all mined. They're over sort of, these guys again were mining 30-gram material, so got gold material out of that. So we pulled all that together and we released this morning actually, so it's the first time I've spoken about this, an exploration target for Bull Oak. Now we think this is quite a conservative exploration target, and it represents a 25 to 36% growth in our total resource. We've extended the mineralisation down just to 260 metres, and we think that's reasonable from an open pit point of view, but Lord Nelson has an optimised pit down to about that depth. And we've extended the mineralisation, again, just within the granodiorite. So we've taken those holes and we've projected them up dip and down dip, and this has been worked through certainly internally by a lot of our consultants as well. And we've taken the grade that was there and then projected that there, and so we're confident that we can grow this resource quite rapidly, and we're planning a 5,000 to 6,000 metre RC program to go and test that, and we believe that we can convert that hopefully into an updated resource on Bull Oak. The key thing about it is that would become one of our biggest single deposits, and it certainly supports a sort of a base load sort of as you're looking towards taking these things into development. So it's quite exciting for us. And that's really where a lot of our short-term resource growth is coming from. But I think that the scale of that is quite exciting. And then we stepped out and we looked at other surroundings. So what's the near mine potential around Bull Oak? And what you're looking at here is all those gold squares are all old shafts and old workings, and the pink circles are other intrusions that haven't got any resources on them at the moment. And you can see there's a significant amount of workings there, so it's just a clear indication that there was gold there. And we've also identified a number of what we believe are other intrusions further out to the east there. So we can see this as a camp becoming a much, much larger area. So that sort of really points to further growth within the Bull Oak region. So I've spoken mainly about the alpha domain, and if we step back, and this is showing, the yellow is the outline of our entire tenement package, which is over 730 square kilometres. And it's been part of the challenge of how we prioritise all of these prospects, because there are multiple targets for us to choose. And so I guess from an M&A perspective, you're not going to see us going out buying more ground and acquiring other projects in the region, because we've got enough targets ourselves. It's about prioritising those. But there's some really tantalising targets, and I think I just want to quickly touch on two of them, which probably were at the time two of the highest grade gold mines in Australia, or certainly in Western Australia. Hacks and Oroya, so we're calling this our Hacks West region. It's our regional exploration. They were both mined in the early 1900s. They both produced over 200,000 ounces at 16 and 25 grams per tonne. So in today's terms, they're company makers in themselves, and there's two historical ones on our property. We're looking at sort of chasing extensions of those along strike, but the key thing that we've done here, and the image you're looking at, is in that sort of 4 kilometre area to the west. There has been quite a bit of drilling there. You'll see sort of from the colours is the max gold. But also what you will see is there's an absolute sort of sparse of drilling to the west there. And our consultants helped us, so that, again, the gold squares and circles that you see are historical workings. So what we're taking out of this is there's a hell of a lot of gold workings in this whole area, and there's been hardly any drilling. And then the next thing that jumped out at us was that Oroya and Hacks are both on a north-south trend, so they're sort of on the page there you'll see, and the reefs are dipping to the west. And if you look at a lot of those old historical workings, they're also on a north-south trend. And there's been hardly any drilling there. So for us, this is a really key and exciting target, and I guess it's in that regional side. So we've got a very safe and sort of near-term growth strategy and story around sort of sandstone and the resources themselves. But if you're looking for a high-grade company-making discovery, this is where it's going, and we have both. So we're really excited about the dual-track process or exploration strategy that we're progressing at the moment on these. And so why Alto? I guess, I think I was saying with Christy, I think the key thing is I'm amazed that we're trading, when you think about where the gold price is at the moment, at around about sort of $20, $21 an ounce. So I think it represents significant value. So that's one thing to put in your screening position. We are in a world-class jurisdiction in Western Australia. There's been significant gold found throughout the whole of Sandstone. You will see that resource continuing to grow. And it is I guess it's underwritten by the existing resources, which are clearly still open. And then we have this high-grade potential and this is what gets us quite excited, because we have multiple opportunities to make a new discovery there, and I think that it's certainly going to be made at Sandstone. And we're just pulling the teams together now to certainly unlock that. So I think that really summarises it. I think it's a very, very exciting project. I'm in booth 40, so I'd love to come and talk to you about the project more. We've got a lot more slides I can go through. And my timing, again, Chrissy, we've got it.
Impeccable. Impeccable. The man is impeccable. Please give him a big round of applause.
Thank you.
Yeah. I always say that is the one thing that you can always rely on Matthew for, and I would presume that it correlates or it goes straight across to what you do in the workplace as well, is when you say you're going to do something, he says he will do it, and it's really reassuring, so thank you very much.
Yeah, thank you.
And he's not bad with a drink out the back. Have a go and chat with him too about his project. All right, Tim, we're going to talk about something completely different now. We're going to go and move to coal, and despite what we hear, what we'd like to think is happening, there is a really big demand for coal to meet growing energy demands, and countries like Japan are looking at us here in Australia for supply. In particular, they're looking to the first new coal supplier on the Australia for the export market, and that is Australian Pacific Coal, and it's Newcastle Spec, to be precise. So in 8 weeks' time, Newcastle Spec is going to be shipped over to Japan, overseas, and that'll be meeting those energy demands which are yet to be met by our future-facing commodities. This is Aitan Saradis. She is the CEO of APC. She's a self-confessed lover of your patch of land here on the Gold Coast, so she fought tooth and nail to be the presenter at this year's conference. She was here last year and enjoyed it so much she's come back. But as I said, last year we were talking about what could be done to get this historical mine ready, and now she's poised, ready to export overseas. So I wonder if any of you actually invested last year. I wonder if you will invest after hearing her this year. Please make her welcome.
Thank you. Thanks, everyone. A year ago, I was here presenting to you about Australian Pacific Coal and the Dartbrook mine. At the time, we said, this is what we're going to do in the next 12 months. And hopefully what you'll see is a vast transformation of this mine in the meantime. Now. Okay, here we go. Okay, just a little bit about the Dartbrook mine. We are actually in the Hunter Valley in New South Wales. We are surrounded by some of the biggest mines in the country, so Bengalla, Mount Pleasant, Mount Arthur. It's all within our neighbourhood. We are close to infrastructure, and we're about 90 kilometres away from Newcastle Port External Terminals, so we're actually in a unique part of the world where there are no new mines opening. In fact, mines are looking at closing. So Australian Pacific Coal, we bought this asset in 2017. Now, this mine was originally owned and operated by Anglo, and in 2006 they put it into care and maintenance. And for nearly 20 years, it's been sitting there in care and maintenance. And we are about to bring it back to life. It's got a long life asset, a resource base, so that we could be running this mine for 100 years, and it's Newcastle Spec Coal, as Matt previously mentioned. So if we go to the... Sorry, but this is not moving. Okay. This is a picture of where the Dartbrook mine is. Now, what you're seeing here is the wash plant. You can see where our neighbours are. So we're in a very unique part of New South Wales where all of the big mines, and these are all export quality coal as well. One thing that's unique though, all of those mines around us, they're all open cut mines. We are one of the very few underground coal mines. When this mine was developed a long time ago, over 20 years ago, they could have done an open cut mine, but they chose to do an underground coal mine. The story is that they could see that ESG was going to be an issue longer term, and they wanted to create a mine that was sustainable. As I mentioned, we are in a strategic position in the Hunter Valley. AQC owns 80% of the mine. We have a 2.5 billion tonnes of resources. If you only look at underground coal mining, it's about 1.2 billion tonnes of resources. In terms of marketable reserves, 370 million tonnes, which means if we're producing about 3 million tonnes per annum, as I said, we can be running this mine for over 100 years. The infrastructure's in place. There is the Hunter Tunnel, there is a wash plant, and it's in great proximity to port and rail facilities, and it's all on site at the moment. One of the features for this coal mine is that we've got development licence till December 27. We need to submit what's called a Mod 8 with the government to extend that lease to 2033. We will have that underway this year, and we will submit those applications. So we expect within 12 months we will be granted that extension to 2033. So in other words, we can get 2033 extension and we don't have to spend any more CapEx than we already have. We're restarting mining in about 2 months' time, and I'll talk a little bit more about that. And we're targeting tonnage of around about 3 million tonnes per annum in production. Now, the wash plant can actually wash about 6 million tonnes. So what we're doing is a modest startup. If we get to Mod 8 and we get the approval for Mod 8 to go to 2033, there is substantial benefit in actually maximising our utilisation of that wash plant. So, as I mentioned previously, this is the first new supply of export quality coal, I would say probably in the country. Not just New South Wales, but in the country. Japan and Korea in particular, there is a Newcastle spec coal that they buy. There is a benchmark pricing for that. And it's actually low cost because the infrastructure is already there and it's actually a very efficient mining operation. We've substantially de-risked this project as well, and I'll talk to that in a little while. But when we first got our hands on this mine, and I took over about 20 months ago, we had the tunnel that was full of water. Everyone said to us, you can't dewater that tunnel. Impossible, too high risk, and about 70 megalitres of water had to be extracted. We've done that. We've also secured funding. $60 million has been provided to us by Vitol, and that's what we needed to fund the capital expenditure. We have a high margin potential. We've produced in the market cost profiles, but we expect in the long run that our costs per tonne is around about $83 to $85 per tonne US dollars. Coal is currently trading $140 US dollars, Newcastle spec coal. So the margin is quite substantial. We're fully permitted to December 27, and then once we get Mod 8, we expect to be mining until 2033. We can continue to apply for extensions, and there is a process that we need to comply with. There'll be an EIS, but the ability to keep us extending this mine is there for the future. Now, you may or may not be aware, but in New South Wales, the government has been very proactive in extending coal-fired power stations and also granting leases for new mining leases as well. And partly the reason for that is that the demand for coal is not subsiding. So there's a lot of conversations that are talked about, the energy transition, but the reality is we need to keep the lights on. In Queensland, I know the Stanwell Power Station, for example, supplies a lot of your electricity. Coal still remains the lowest cost producer for electricity. And until we can change that, there is still a story to be told and a value and a position for coal in the energy space. We have world-class surface infrastructure in place. Now, I talk about this and I look at our market cap. My market cap's anywhere between $40 and $50 million. What I will say is that if you had to build this mine from scratch today, conservatively, I'd say you're probably spending $1 billion. So the infrastructure we have, no one's going to build a mine like this ever again, because the reality is you just couldn't make the economics or the political rhetoric around it add up. So we are lucky enough that we bought this acquisition, we bought this asset, and the infrastructure's already there. We talk about Newcastle spec coal. So the coal that we have is going to be sold into the export market at a benchmark price. There is potential upside though, and we will be taking a bulk sample next month to send it off for testing, because we believe that the seams that we'll be going into is possibly also semi-soft or PCI quality. So in other words, met coal quality. And look, as a coal mine operator, we are committed to the safety and our communities. And I'll show you a video at the end of this presentation. But it's imperative for us to make sure that we look after this asset that we've been given and the beautiful infrastructure that we have in terms of where we're located. It's very lush, it's very green, but we are conscious of our obligations around the environment as well. Oops. I can't go back. If someone can help me go back to the slide. Thank you. Now, this is a slide that I do like showing everyone. You can see here that the purple line at the bottom is the Hunter Tunnel. And you will see that above ground, it's very green. You've got the Hunter River there. You've got the New England Highway. And across the road, where you've got that white infrastructure, that's where the wash plant is. So if you're driving down the New England Highway, you'll see the wash plant, but then you'll look to the other side of the road and all you can see is green grass and a lot of cows. You won't see the mining activities, not like our neighbours. When this mine was previously mined, it was mined in the Wind Seam. We are actually targeting the Cayuga Seam, which is up the top, you can see there on the dark side. That is where I would say is the sweet spot for the coal in terms of quality. What we have is the infrastructure we will be mining. In that tunnel, we have conveyor systems. So everything goes on those conveyors and is transported right across the road over to the wash plant. We've also got the rail loop in place, and so we can connect to the rail network fairly efficiently. As I said, this is world-class infrastructure. It will never be rebuilt. We've talked about the reserves and resources here, but what I do want to talk about is the quality of the coal. We've talked about Newcastle spec thermal coal, which is used in coal-fired power stations. There is also the potential, and we will get the testing done, that this is semi-soft and PCI. Now, the Cayuga and Pierceville seams, they're the same seams that our neighbours are producing at the moment out of, and they are semi-soft and PCI. Now, we'll get the testing done to prove that up, but if that is the case, then we've got a very valuable asset that will also be sold into the met coal market. We've put up some key operating metrics here for those of you who are interested, but effectively we've got an asset that is fully developed, it's ready to roll, it's first cab off the rank, and there's not much else for us to do except to get the equipment there and start the mining operations. As I talked about, we are strategically positioned for the export market. Now, with this slide, that graph at the bottom, what I will show you is that the demand for export quality coal is not subsiding. It's not going to subside for a long time. We see a lot of buyers out of Japan and Korea. In fact, we've got some buyers out of Korea on site today. The demand is not subsiding, and when you look at places like Japan and Korea, they can't put windmills and solar-powered power stations on site in their country. We know their history of nuclear. Their only other alternative is thermal coal-powered coal-fired power stations. So the demand is not subsiding, despite the rhetoric around energy transition. From a cost perspective as well, the demand is not subsiding. And as you can see on the price chart, we had a huge peak. Now, people will say to you, oh, that was because of the Russian-Ukrainian war. The reality is, when the Russian-Ukrainian war actually started, coal prices were already starting to peak up, and it was about $185 per tonne US. So a resolution of the Russia-Ukraine dispute, I don't think is going to impact coal prices in the long run. And that flatness of the curve, you look at any coal price forecast, it's always a flat curve like that. So I don't buy it. I don't think the supply demand justifies it either. A year ago when I was standing here, we said we've got all of these activities, we've got to simplify our JV structure, we've got to get the Hunter Tunnel dewatered, we need to get the funding, and we need to build some strategic alliances. Today we've achieved all of those, and I'm conscious of time, so I'm going to flick through these fairly quickly. Our coal, we will be taking bulk samples next month, and we expect in August or September to send the mining equipment down to start mining. It'll be unwashed coal initially, but with a view that we will have the wash plant ready in the first quarter of next year to sell washed coal to the market. There's some financial metrics for those who are interested, but you can see the financial add up quite compellingly. A little bit about AQC. And again, energy transition, I've talked enough about that, but what I want to show you now is a video of the Dartbrook mine. I've talked about it. We're ready to mine and we are the first cab off the rank, but I want to show you a quick video if we can as well. We can't?
Sorry. Well, you would have go to lunch. This is leave
Look,
them
come to our booth.
Yes.
And we do have the video, but you can see it, and it's a beautiful part of Newcastle.
Thank you very much. Would you please make her very welcome? And go and have a chat with her. All right, so that's a warning for me to be quick as well. We're going to talk about Alltech batteries next up, and Martin Stein is their CEO. Is Martin doing this? Who's doing this? Oh, come up and introduce yourself to people, quick. I've got an interloper here. Regardless, so what Alltech has done recently is they've just wrapped up a very successful share purchase plan, and the aim of that is to support Alltech's ongoing projects and also their strategic initiatives to strengthen their position in the battery sector. So introduce yourself to everyone. You're missing the glasses of the great man.
I'm not the CEO, Chrissy.
Right.
Unfortunately, I'm the CFO. Iggy can't join us today, but I'm working side by side with him, so thanks for the opportunity. So we'll talk about the future of grid storage batteries. Just out of curiosity, can I ask the audience who's aware of what a grid storage battery is? Perhaps put your hand up. Not many people. All right, well, we'll talk about what that is. But first of all, I want to talk about a lithium-ion battery. Lithium-ion batteries have organic material that catches on fire. What the industry is trying to do is to move towards what's called a solid-state technology, replacing the flammable electrolyte with a solid-state technology that can't catch on fire. We've seen all the fires with the lithium-ion batteries, car fires with charging scooters, the EV catches on fire, and what's happening here is the oxygen's being produced at the cathode level and fueling the fire. One of the other restrictions with lithium-ion batteries is the heat and the temperatures that they can operate in. The lithium becomes viscous outside of 15 degrees and 35 degrees, and the charging efficiency decreases in those outside of those temperatures. So lithium-ion batteries are really restricted to a certain temperature range. If they fall outside of that range, they lose capacity. So not very good in cold or hot climates. They also have a limited life, just like your mobile phones. They charge and discharge great at first, but they lose chargeability. They're limited for about 8 years. Raw materials as well. Lithium-ion batteries obviously use the lithium, but not just that. They're using a wide range of raw materials. They're at the mercy of the supply chain and the cost for graphite. 90% of the world's graphite comes from China. China's got a control over that raw material, and They're actually restricting the exports on graphite. Lithium-ion batteries also use cobalt at the cathode side, and 70% of the world's cobalt is sourced from the Democratic Republic of Congo. We're all aware of the supply chain and ethical issues in sourcing that cobalt from that region. And of course, copper. A lot of copper used in internal combustion in electric vehicles, 2.5 times more used in electric vehicles than internal combustion engines, and a lot of experts are saying there's simply not enough copper coming online to support the world's requirements as it transitions to a renewable energy economy. So is there a battery technology that is fire and explosion proof, that has a long life of 15 years, that can be used in a wide range of temperatures and amazingly doesn't use lithium, copper, cobalt, graphite or manganese? Well, we do have a product, and that's what Altec has. It's called the Serenergy battery. It's a sodium chloride solid state battery, sodium chloride being common table salt. Now, this battery technology was developed and researched by the world-leading German Institute Fraunhofer. Fraunhofer has spent 35 million euros developing this technology. All of the research and development's been done. Altec with Fraunhofer are now commercializing this battery technology. So the Serenergy battery, it doesn't have the viscous issues of lithium. We can operate this battery in temperature ranges from -40 to +60 degrees. We can take this technology anywhere in the world and it's going to work fine. We also have a long life of 15 years, and that is simply because we don't use lithium, which degrades. We use sodium chloride, and the sodium does not degrade with each charge and discharge. And importantly, these batteries cannot catch on fire or explode. There's simply nothing in them to cause any fire, and there's nothing in them that's flammable. So completely safe batteries. So this is the chemistry, and this is the technology of how it works. What we do is we take a ceramic tube, an electrolyte. Inside of that, we put a positive terminal, and then we put the salt, the sodium chloride, and we also put nickel powder into the electrolyte. That whole unit then sits inside a stainless steel shimmy, and the stainless steel shimmy then sits inside a canister, and there's a gap between the shimmy and the canister, and that's important. So there we have a 250 watt cell, about the same size as a residential solar panel. Now what happens is the battery charges. The chemistry involved in that is that the chloride from the sodium chloride sticks to the nickel, the sodium migrates through the ceramic electrolyte, and it forms a sodium molten self-forming anode between the electrolyte and the stainless steel canister. That is the key to the technology, and that is why we don't use the copper, the manganese, the cobalt. So when we charge the battery, we have the sodium migrating through and forming a metal, sodium molten anode. And then when we discharge the battery, the reverse happens. The sodium ions then migrate back through the ceramic electrolyte, cling back onto the chloride ions and form sodium chloride again. So how do we compare against the other technologies on the market? Well, the two main types of battery technologies are the redox flow and the lithium-ion battery. Now, density, we're a little bit less than the lithium-ion batteries, but we're targeting a stationary battery where weight isn't so important. And we're obviously a lot bigger than the redox flow batteries, and we know there's a market for redox flow. They're selling them into the Californian grid. All the other attributes, we're very competitive where we exceed the other technology. The maintenance cost is an important one. We're very cheap. We have low maintenance cost over the life of the battery. Now, this table shows how we compare to other technologies in terms of power and energy capacity. So we sit in the middle. We have a good amount of power and we have a good amount of energy. And for grid storage batteries, which I'm going to touch on, that's exactly what you need. So this is the opportunity that is facing the world and that Altec is providing a solution to. This represents a typical grid situation where renewable energy, solar and wind, putting energy into the grid. Now, what's happening around the world is that the renewables are being produced in excess, the grid can't support that power, and there's literally money being wasted into the ground that the grid can't support. 2 billion US in Germany was wasted in electricity, in renewable energy that the grid couldn't support, put back into the ground. Renewable energy, solar power is also intermittent in its production. It doesn't produce it at night, as everyone knows, but the grid requires it at night. The solution to this, and what is happening around the world in the nascent industry that is grid storage batteries, is that massive sea container sized batteries are being put onto the grids, supporting the renewable energy production when it's produced, storing it and then returning it into the grid in the evening and when it's required. And this basically represents the future of the renewable energy transition. It's a nascent industry. It's growing at 28% compound annual growth rate. And we've got technology here that we're commercialising to get into that market. Now, this shows some of Fraunhofer's pilot plant facilities that they have in Germany, where all the research and development's been done. And I stress again, the research and development is all completed, so that risk isn't there. We're now just commercialising this product. You can see there a finished 10 kilowatt hour battery. It's undergoing test work. Fraunhofer being German government, very credible, very reputable. Altec's extremely fortunate to have them as a joint venture partner. We can see there some ceramic cells being pressed. They then go into a kiln that operates at 1600 degrees that dries those ceramic electrolytes. There's another finished 10 kilowatt hour module. It's been tested, it's working. So now Altec and the joint venture is tasked with scaling this up to industrial production, and we're doing that in Germany. We own 14 hectares of land in the state of Saxony, which is a renewable energy hub and battery hub. We've got the 14 hectares over there. This is where we're commercialising a 120 megawatt hour plant. This is what it will look like. It will be all renewable energy run. And the good thing about the Serenergy battery is that it's 100% recyclable. It'll be able to be recycled at our facility, so it meets all the ESG requirements. Now, what this shows is a rack of 48 cells. We then take 5 of those racks to give 240 cells. We put it inside a chest like that. That's called the 60 kilowatt battery pack. 18 of those battery packs will be put into a standard 20-foot sea container, and that provides 1 megawatt hour of battery capacity. Very simple design. It's a plug-and-play design. It can be transported to the customer's premises. Within 5 minutes of arriving, the customer can have 1 megawatt of hour of power connected to the grid. In March this year, so very recently, we released our definitive feasibility study with our financials, and the economics stack up. We have a euro 109 million revenue per annum. We have a net present value of 169 million euros, and we have an EBITDA of 51 million euros per annum. So we have an economic project here, and it's also important to remember that this is a first stage of the joint venture. It's a 120 megawatt hour plant. With battery production, it's going to be about economies of scale. Obviously, if you can produce at a capacity much more than that, your costs are going to come down a lot. The second train of the joint venture will look at gigawatts, and we have the worldwide rights to manufacture, license and distribute this product all around the world. But first stage, we must achieve the 120 megawatt hour plant in Germany. Here's just some animation of what you can see here, the 60 kilowatt hour battery pack being put into the sea container design. We've selected all of our German suppliers. They're highly experienced in robotics, having come from the automobile industry. So we think we've assembled a very good team of suppliers that will be able to make this technology a success in Germany. You can see there the electrolyte being put inside the stainless steel shimmy. That shimmy then sits inside the stainless steel canister. That's a 250 watt cell. Some salt and nickel powder being measured out there. That then gets poured into the electrolyte. The tops are welded. That then undergoes heat testing. Fraunhofer have done all this work over the last 8 years. Very exciting technology. It's got a lot of potential to go global. There's two 60 kilowatt hour battery packs that we're fabricating at the moment. They've nearly been completed. We'll provide them to customers for real world testing. Here's some animation here of what the plant is envisaged to look like. As I mentioned, all German suppliers. So this is the future of the renewable energy transition. I like to tell a story about what happened in the state of California just a few weeks back, very recently. California is the biggest producer of renewable energy in the world. For one evening a few weeks ago, for the first time ever, the biggest source of energy into the Californian grid wasn't from gas, coal, nuclear, renewables. The biggest source of energy into the grid on one evening was from batteries. 6 gigawatt hours of capacity of battery was put into the grid. It's a sign of where the world is heading with renewable energy transition. We have a technology here that is being commercialized. We have a nascent industry where it's going to be very lucrative, and we've got a lot of potential. We're listed on the ASX under the code ATC. So thank you very much for listening, and thanks everyone for your time.
Right. Thank you, Not Martin. That was a fantastically interesting speech. I enjoyed that. It's good to see you expanding at the end there too with the vision, more and more vision, more and more things happening.
We always like to improve, Chrissy.
I know you do. Thank you. Go and have a chat with him, everyone, afterwards. All right, we're talking to a very happy CEO next up, David Self. Where did you end up? You down the side there? Oh, look, we've got the luxury seats now down the side there. We should charge you more for those. This is David Self, everyone. He is the CEO, aren't you, for TG6 Metals. So at the start of the day, remember Jackson said you need to stay and listen to this presentation. So Stewie, if you're at home playing along right now, this is the presentation that he was alluding to. Now, this gentleman here is exceptionally happy today because they've just started drilling again as of today. Jagermaster. They've also got metallurgical test results, seismic results pending, and that should show us just how big the potential is of this project. Would you please make welcome David Self.
Thank you, Chrissy, and thanks to Vertical Events and ORU for putting on this conference. I find it interesting that Alltech in their battery technology uses ceramics. Does anyone know what spodumene was used for before lithium batteries? Ceramics. So there you go. Perhaps not totally lithium free after all. So anyway, TG Metals. Usual disclaimer, you read at your leisure. So we're a lithium-focused exploration and development company based in Western Australia, and we have had our recent discovery in October last year of the Burmeister lithium pegmatite. It's a high-grade deposit. Since then we've been actively drilling on that to get a first target statement out on that with a top level of 20 million tonnes in rapid time. So we've had a lot of success there. We're about to start a maiden drilling program. In fact, we've started today on our Jägermeister prospect, which is adjacent to Burmeister. It has lithium in soil anomalies there, which are larger than our Burmeister discovery. So we're very excited about getting our first drill holes into that. And we should have results coming in the next couple of weeks from that particular program. We've also completed a seismic program across Burmeister and Jägermeister, and we are excited about the interpretations which are coming out of that. They're not quite ready for basically displaying yet, but they're still underway. But they'll improve our drilling targeting, as well as give us a great indication of exactly how big this system is. We believe it's of a size. And also doing our first metallurgical test work as well. We're getting into that early, so we drilled diamond drill holes early on in our drilling program, twinning our RC holes, and that's basically to make sure that we get enough sample together for our first metallurgical test work. It's very important on these pegmatites to know that you can actually process them and get a decent concentrate out of them, and so that's what we're progressing there as well. And there's a picture there up on the screen now of some HLS tests in a beaker. So just on a corporate overview, we don't have many shares on issue because we have only raised once more since our IPO. So we haven't diluted our shareholders down much. We have still have a healthy cash balance in the bank, enough now to progress all of our aims for 2024. We don't have to go back to the market anytime soon. But our market cap's fairly low. I mean, and certainly our enterprise value at 5.1 million there, you couldn't drill out Burmeister for that money now. So are we undervalued? Absolutely we are. We still have most of our top shareholders, the top 50s, have stayed with us and take up around 55% of the stock. We've got a very good board as well, very experienced, and a mix of technical, marketing, and also capital raising. So whereabouts are we? So we're in the Lake Johnson region of Western Australia. It hasn't had the actual greenstone belt. It sits there between the Forrestania greenstone belt and the Norseman Wiluna belt, which are more well known, I suppose, because of the larger discoveries there, and the operating mines. So we've got 4 operating mines around us at Earl Grey, Mount Marion, Bald Hill, and Mount Catlin to the south. So we're not an orphan in the region, but certainly we believe that we have in our area the largest lithium spodumene deposit, and also the highest grade. So. And we've got a lot more ground. We've got the big land holding, so there's more discoveries to come, and we're progressing with those as we go. And as you'll see, we've only really explored probably about a third of our total land holding for lithium. And past exploration, it hasn't really had a lot of attention. So we're a first mover in the area. Just on a Burmeister lithium pegmatite deposit. So this is a picture here of the actual modelling. So when we generated the exploration target, we actually used our drill holes. They were the first drill holes into the deposit. It's a completely blind deposit, no outcrop whatsoever. It was found through a soil sampling. So you can see there's soil sample contours there, and extending out to the east to Jägermeister. So we got some high grade, or high tenor, I should say, soil anomalies above the Burmeister deposit. We put some holes in, initial 9, and in October last year, and we got instant hits of high grade lithium pegmatites. And we're hoping to replicate that over on the Jägermeister side. So it's a stacked pegmatite system at Burmeister. It's the main deposit's 1,500 metres long, which is a substantial length and makes a substantial pit. As you can see there, the 2 pit shells that were done, one at $1,500 a tonne SC6, which is a 6% lithium oxide concentrate price, and 2,500. The reason why we chose those 2 is because that's what's basically being used by others in feasibility studies at the moment. So it also is a useful pointer for us on how much of the deposit gets captured within a pit shell, and on the 2,500 pit shell, it's 95% of what was being modelled is actually in the pit. We have to call them conceptual pit shells because it's not a JORC compliant resource at the moment, but we're moving towards there. As I said, so the range was 15.6 to 20 million tonnes, 0.97 to 1.19. We believe we'll be able to exceed that easily once we do our infill drilling, and also use the seismic results to define more pegmatites within the actual Burmeister area as well. It's a significant deposit on its own at 20 million tonnes. It's of a potential standalone size. The average plants for these deposits is around 1 to 2 million tonnes per annum. So on a 20 million tonnes, you're looking at around a minimum 10-year mine life. And as I said, we believe we'll probably get more tonnes than that out of there once we do our infill drilling. There's some of our better intercepts there as well. So it gets quite thick, up to almost 24 metres in thickness. It's high grade, and importantly, the mineralisation is very consistent. So unlike a lot of other pegmatite deposits where there's blank areas within the pegmatites where there's lepidolite or petalite present, we have spodumene throughout, and wherever we get pegmatite, we've got grade. So there's no blanks in there, no internal waste to worry about, and it should be easy mining. There's a long section basically showing the pegmatites and the shells. As you can see, the shells went right down, in most cases, right down to the bottom of what we had modelled for the pegmatites. So we've got plenty of scope to increase that at depth, and we'll certainly be looking at that in our next phase of drilling at Burmeister. And also our seismic will also tell us how deep these things go as well. So also, as I said before, the spodumene occurs throughout the pegmatites, which makes it a consistent grade throughout, which helps us with our drilling. So we should be able to do our inferred resource on 100 by 100 metres, which is pretty much unheard of in pegmatites elsewhere. Most times you've got to drill them out like a pincushion to actually get any resource whatsoever. A lot of them don't even reach a measured resource because of the variability within the pegmatites. Ours is very consistent, which is unusual, but a lot of pegmatites, or most pegmatites, are unique in their own characteristics. Just on the mineralogy, so we did this early on through our core. We wanted to see what else we had within there. We got a lot of feedback from people saying, oh, you're bound to have a lot of lepidolite in there, you're going to have petalite in there. We didn't find any of that. So we've got spodumene. Spodumene is the dominant mineral in the actual pegmatite, so it's a true spodumene pegmatite. The next most abundant mineral in that's quartz. So and it's also the only potential other lithium in there is zinnwaldite, which is only a small fraction, and it may not even contain any lithium in it, in the zinnwaldite whatsoever. So to progress that further, we've started doing metallurgical tests. So we've got CIDA tests underway now. We added some basalt waste to our metallurgical test work samples. That's to simulate a real-world mining operation. So we add about 10% of basalt to the mix, and then that gets removed by first stage ore sorting, and that works really well. It takes most of the basalt out that goes in that you can't avoid pulling in when you're mining. We then followed that up with heavy liquid separation, HLS test work afterwards. That's the cheapest form of getting a concentrate for lithium spodumene. And so we're hoping that that'll be the dominant processing method that we need to use. Following on from that, we'll also do some flotation tests on the finer fractions, but we're hoping that we won't get a lot of that in our ore as well. So those test works are ongoing, but we should have, probably in the next 6 to 8 weeks, we should have the results of that as well. And then we'll be able to select our preferred flow sheet. Just on Jägermeister, so where we're drilling at the moment is on target A and B on Jägermeister. You can see the seismic lines that we've done across there as well on Jägermeister and on Burmeister. All of our drilling POWs have been approved, and drilling's underway. We've got 5 targets to test at Jägermeister, so it'll be a while drilling there, but as we get our results in, we'll report them straight away. Other emerging prospects, so we've got a lot more tenure than just that. So you can see there the black box around there is what we've tested so far. We've got a lot more ground to test, and we'll be doing that as we go on to go onwards. So basically our ongoing exploration, we're delivering results, we're getting discoveries, and we're improving our knowledge of the area. We're opening up a large lithium pegmatite system. So just in summary, we evaluate our lithium mineralisation early, see what we've got. We're into discoveries. We've discovered the Burmeister deposit. We're pretty confident we'll get something at Jägermeister. How big, we don't know yet. Drilling will tell. Exploration science is working. Soil sampling works for our area. We know it doesn't work everywhere for everyone. We understand that, but where we are, it works. We've discovered Burmeister through it, and Jägermeister's shaping up as well. We're getting our drilling done. We've got growth prospects as well with our land holding and our emerging large system. And the experience of our management and board is impeccable. We've got a lot of lithium experience from other operations that we can apply to what we've got. And thank you.
Thank you. Yeah, I looked you up. You are correct. Ceramic and other glasses. Well done. You do know your stuff. Thank you very much. Okay. All right, we're going to do another redirection now. We're travelling to rare earths, which are not just a critical but also a strategic mineral as well. And they're 80 to 90% controlled by China, as most of us know at this point in time. So how do we get our hands on them outside of that particular jurisdiction? Where do we go to? We could go to Africa, because Africa at the moment is causing a bit of a stir. It's finding itself on the radar of Western companies as a way to provide that supply security, particularly by the US. So, segue to this company. We have DY6 Metals. This is our next investment prospect for you. Why should you be adding this to your portfolio? This is the CEO, Lloyd Kaiser. Now, a bit of a background on Lloyd for you all. He's actually Perth-based, but guess where he spent last night? And guess where he's spending tomorrow night? Sleeping in his childhood bedroom here on the Gold Coast. His mum and dad still have the family property, which would be a really nice little investment as well. He did tell me that he's not in a single bed. They upgraded, he's now in a double bed in his old bedroom. So, but he's enjoying being back here, and he's enjoying bringing this prospect to you. So please make him very welcome.
Thank you, Chrissy. Yes, as Chrissy was just mentioned, I'm from WA and was originally from Ipswich and lived in the Gold Coast. My family's still here. But today I'm actually talking about projects in Malawi. So it's quite an adventure for me, given that I've been in WA for 20 years and worked in another rare earth project that was actually in the Northern Territory for 10 years. So today I want to talk about our projects that are in Malawi. So Malawi's actually a jurisdiction that there's many proponents or many companies exploring or developing in Malawi. We're not the only one, DY6, that has sort of many prospects. So before I sort of go into our projects, I think it's probably fair to just go through some of the other projects that are in this area. So you may have heard of Lotus. They're in the north. It's a uranium project. They're currently in front-end engineering design. Globe Mining and Metals is prospecting for niobium. They're already, I think, somewhere in piloting or PFS. Sovereign Metals is a rutile graphite project. It's already done a feasibility study, had $40 million injected by Rio Tinto. We're 40 kilometres west, our Machinga project, our main heavy rare earth project, from the Lindian project, which is a carbonatite rare earth complex. And then south of that, there's Songwei Hill, which is next to our other project that we've acquired called Tundulu. So there's a number of ASX listed companies that are operating in Malawi, and the projects that we have in Malawi are all critical metals projects that are focused on rare earths, niobium, lithium. The Machinga project, we have a maiden drilling program that was completed for 4,500 metres. Last year we've done comprehensive rock and soil samples for 860 samples. That was over a period of 2 stages. It's heavy rare earth rich and has niobium credits as well. It's 29% heavy rare earths to TREO. The other project that I'll talk more about today, so I won't be able to go over all of them, is Tundulu. We're quite excited about this. It's a large carbonatite ring complex with drill sections exceeding 1% TREO. The licence granted only a couple of weeks ago. I know that the floor has talked about sort of licences and what it takes to get a licence, but in Malawi it takes about 6 months. We put the application in December. It has to go through the Environmental Protection Authority with some documents, and then a licence is granted for us to do work on. We've acquired some quality historical drilling data, which I'm going to go over. The other project, Mzimba Karonga, is lithium. We've done some small reconnaissance work there. It's shown this mostly lepidolite mica with grades around 6%. Selen Bidway completed comprehensive geochem sampling, geophysics, and Ngala is a PGE copper nickel prospect. So just quickly on the corporate snapshot, it's shares on issue is about 58 million shares, market cap's around 4.7, very low enterprise value. So we've 60% of the shares are held by the top 20. You can see here just more recently, as of May, the Tundulu project was well received by the market. It traded at almost 18 million shares on that day. It was almost up 450%. I think it's had more liquidity in the last, on that day than it has all year, so the stock is starting to be a little bit more liquid. So the Tundulu project is made up of formed of this multiple ring complex around this central vent. It says Nathas Hill, but it's actually referred to as Natasha Hill. There's other ring structures that are also present to the west and east of Natasha Hill. It's a large rare earth phosphate hosted mineralised deposit. We've got acquired quality historical data, and it's mineral rich in rare earth carbonatite and also rare earth phosphate. This is the Tundulu project. So there's been previously shallow 50-metre drills by the Japanese in 1988, and then 2014, 7,000 metres of drilling. Most of this was all done around Natasha Hill to the east side, as you can see. And some of the notable drill sections that we have are plus 100 metres of 1 to 1.5% TREO. This is a carbonatite, as I said, complex. The carbonate minerals are anchorite, calcite, dolomite. It also has this silicate minerals that's surrounding on the outside from the later stage intrusion of this nepheline cyanide. This is very strongly mineralised sort of outcropping. The outcropping is everywhere along the west side and also the southern side. And also this is a photo showing some of the east side where the outcropping is. This is a drill section where the Japanese actually didn't even drill that deep, and some of the mineralisation ends at the end of hole. So this remains open on the east side and also to go up higher, and then opportunity lies in the west and also in the south side. So our next steps is really the discovery, so resource-focused exploration. There's obviously a large carbonatite footprint. You can see here there's been rock chip entrenching that's been done around Natasha Hill on the east side. We've had rock chips grading between 1 and 6%. We'll plan to do more, of course, rock chip sampling on the west and southern side of Natasha Hill, and then also at Tundulu as well. So that's what those circles around those two ring structures is about. There's also opportunity at Makanga Hill. And so DY6 at the moment was planning a comprehensive sampling over those targets before we engage in targeted drilling. Just sort of moving along, I thought I'd just show some sort of comparison of other projects that, of course, a lot of these projects have moved beyond exploration and development into piloting, PFS or feasibility studies. But you can see there's always a staged approach in terms of getting a mineral resource estimate and then moving on to a much bigger resource. But the market cap of these companies are far higher than where DY6 is at the moment at 4.7. But we do have potential from this carbonatite complex to have a significant mineral resource in the future. And over this phase of the next year, we'll start to do more of this exploration work, including some drilling. We've already commenced the geological modelling, so we know roughly what the size is of the data that we have to date. We're not planning to put out an exploration target, but our preference is to make sure we do this comprehensive rock chip sampling, aim for some more drilling, and then aim to look at putting a resource statement out. I've got about 5 minutes to go, so I thought I'd just cover off Machinga. Machinga's not like Tundulu, it's an alkaline intrusive complex, it's not a carbonatite complex. We completed about 4,000 metres of drilling at that site. It's a heavy rare earth enriched deposit. It's got some good grades of niobium as well, widespread heavy rare earth mineralisation. We'd like to do more drilling, of course, and follow that anomaly. It's a uranium radiometric anomaly. And the aim is to do more work on rock chip sampling before we do more drilling. So with the next slide, you can see here, beginning of this year, we completed a more comprehensive rock chip sampling across the two licence areas, following that anomaly or contour. And there's more scope, of course, to do more sampling in that area on the southern side. So the strike is going from a northwest to a southeast strike direction. So there is scale potential for greater mineralisation further south. So from the sampling program, then we'll decide on what those next drill targets will be for Machinga. So in terms of milestones for the second half of the year, our near-term goal, of course, is to work more around Tundulu. We've got a team of geologists that are housed not far from Tundulu, and they'll be looking to commence the work at Tundulu. So at this stage, it's really having this data that we've acquired. It's a knowledge building stage, review of this historical data. We've got a lot there, including geophysics. We're planning a rock chip sampling program that'll be across that west and south side. We have commenced initial metallurgy work that'll be focused in the second half. We're looking this month to go towards one of the open trenches and collect a 150 kilogram sample and send that to a Perth lab to do some initial metallurgy work that's focused on a dual product where we look at a rare earth concentrate and a rare earth phosphate containing rare earths. And then the future drill testing areas, well, that'll be based on what the outcomes are of this rock chip sampling program. With Machinga, soil sampling is planned in that extended area that I outlined before, and then we'll look at identifying what those future drill holes will be. Mineralogy investigation, we've already completed that and we're reviewing that, and we're going to commence preliminary metallurgy on some quarter core samples that's also sitting in Perth. With Nangala, that's the PGE copper nickel project. We've got some historical data there, but we'll look at doing a small reconnaissance sampling program in the second half. And Mzimba, where the lithium prospect is, same thing, we'll look at doing a comprehensive program. So I think we've got a lot of activities for DY6, and the opportunities look fantastic, including our project in Tundulu. So I look forward to speaking to you later today at the event and tomorrow. Thank you.
Thank you very much, Lloyd. But don't keep him too long because he's got things to do at home. No. Malawi, is Malawi interesting? I haven't been to Malawi yet. Is it a good little country to go to?
I think it's interesting, yes.
Yeah, really interesting. I have to put that one on my list of places to go with all the money that I'm earning at these conferences. How are you? Good? Good, okay. You hungry for lunch? Well, guess what? I've got one more investment opportunity for you. You should be hungrier for that one because this could be make or break. George Sakalatis, hello, sir.
Hi.
Now, George is not just the MD of the final company before lunch for your perusal, he's also the founder, something he's very, very passionate about. So it's an interesting company, Magnetic Resources. They've got several advanced gold projects in a world-class gold belt, and they've also got several long-standing high net worth individuals in their shareholder register. So what's keeping them there? Let's welcome George and find out.
Okay, thank you. It's good to be back again. Haven't presented here for a while, but it's good to see everyone today. Yeah, so the talk's divided into separate sections, and we'll talk about the executive summary to start with. We have three main deposits: Lady Julie Central, Lady Julie North 4 and HN9. Those three deposits make up 1.15 million ounces. They're quite remarkable deposits, and we'll talk more about those, but that's the main theme. In terms of the register, which you mentioned before, it is very tightly held stock. A lot of the share price performance is based on our fantastic drilling intersections. The top 20 own 71%, and the top 4 own 45%. So many high net worth investors, and they've been involved with me with a number of companies. We have the main brokers involved are Morgans and Argonaut. And you can see some of the names on the right. Dale Wilcock's got about 11%. I think he's the second biggest home builder in Australia. The share price currently is around $1.02. Yeah, so the main project is at Leonora Laverton and the Lady Julie Gold project. That's the main thing we're talking about. You can see we've got 1.3 million ounces in total. 1.15 of those currently are at our Laverton project. Okay, so part of the intrigue is that we've made these discoveries next door to three big processing plants owned by some much bigger companies. Genesis have got a plant which is in care and maintenance. It's about 10 k's to the southwest. To the east we have Goldfields that own the Wallaby and the Granny Smith processing plant, and further south we have Anglo, who own the Sunrise Dam. Now all these companies aren't producing at full capacity. In fact, obviously Genesis, it's on care and maintenance, so it's a great opportunity for us. Secondly, Goldfields are operating at less than half capacity, and Anglo also need new ore to blend. So because there's a lot of M&A, we have deliberately been talking to these companies, and they've been in our data room, reviewing all their data, so we've got nothing to hide. and a lot of these companies are in their final due diligence mode. So we'll see where that goes. That's sort of the plan A, and the plan B is for us to go into production as well. And you'll see some of the numbers from our PFS study, which we'll put out a couple of months back, are sensational, and they're going to improve as well. Yeah, so this plan on the right-hand side is a long section, and the long section shows the gram metres. And when you show gram metres, it gives you a total sense of the amount of gold in that deposit. So that is continuous over the 750 metres. It shows the southern end, very high gram metres, up to 300, and the northern end. When we first started drilling here, we were getting some pretty good results in the southern end. We were pretty excited, but the northern end we kind of didn't quite discount, but we elected to do more drilling there. And now we're seeing that the northern end is getting bigger and bigger. You can see that red line shows a 600 metre plunge, and we're currently drilling underneath the page. So we're drilling holes down to 6, 7 and 800 metres because we're getting the intersections and the grade. So the latest one we put out, we had 25 metres at 3.9 grams from 380 metres, which is mineable underground. So a few months back, we weren't looking at underground. It was mainly an open cut. You can see that black line is a shape of the optimised pit. But now it looks like the optimised pit is going to get bigger, and at the same time we're finding the underground. So we don't know how big this will be. The current resource at 1.3 I think is going to be much lower than the actual estimate. Yeah, so part of our PFS study showed that this would be the highest grade open cut deposit in West Australia. So on the left-hand side you can see 1.9 grams. So it's way above the other companies. The internal rate of return was 85%, but that was done at a $2,800 gold price. So these numbers are all going to improve. And these are the numbers we calculated a number of months ago. They were done at 2,800 Australian dollar. Currently, the Australian dollar price is around 3,450, sometimes 3,500 and sometimes higher. So these numbers, even though they're pretty amazing, the NPV 547 million, EBITDA 982 million, with the new spot pricing, you know, the NPV is going to go close to 900 or much greater. So they're big numbers. So it gives you an idea on the value of what we have. So with this new drilling, we're currently in the mode of updating the mineral resource. Once we've done that, we'll rerun the economic numbers to give ourselves and our shareholders a better view on what the value is of these deposits. So that'll probably come up over the next month. More mining focus, you can see at the northern end we have Lady Julie North 4. In the middle, Lady Julie Central, and down the southern end it's HN9. They're all about 2 kilometres apart from each other. So it's part of one mining camp. The two deposits, Lady Julie Central, HN9, start from surface, and Lady Julie North 4 starts from 30 metres down. So they're relatively shallow deposits. Clearly, if they're outcrop, very shallow. So you can see the layout of the mine plan, which was included in our PFS. You can also see that there's a 1.15 million ounce resource in these 3 deposits, but the average grade is about 1.8. In terms of these updated announcements on resources, you know, all this will change. So I guess we'll look forward to the next lot of results. This gives you a bit of an idea on how it's going to be mined. You can see, assuming a 9-year mine life, which will change, but this is what was calculated. In years 6, 7, 8 and 9, there'll be 100,000 ounces being mined. Now this is quite an interesting, I guess, section. It it gives you a bit of a view on how we're thinking. In terms of the drilling that we've done to date, it's all been trying to extend the size of the intersections in an easterly direction, so progressively going down, and we keep intersecting load systems. In the southern end, we're getting multiple stack loads, just like we see here. And where we see multiple stack loads, that twigs the idea, well, are there other stack loads beneath? We know that in the region, stack loads are common, and they're the main ingredient for these really big resources. At Wallaby, there's 7 million ounces. That's stacked down to 2 kilometres. Sunrise Dam, similar, stacking downwards. Huge resource there, 16 million ounces. So clearly what we've been doing is tinkering with the down dip, extending it. We've got 1.3 that's going to grow. But if we do get the stacked loads, and we have put a hole through the guts of that, going down to 700 metres, so it's literally, there's about a 400 metre distance of new rocks potential for stack loads. So I'm waiting on that result as well. I'm hoping we get stack loads, but let's wait and see. Okay, so this is for the mining plan. You can see part of the mining group or the workforce is 84 people. It's a stage mining. The first deposit will be Lady Julie Central. That'll pay for the pre-strip of Lady Julie North 4. Lady Julie North 4 had some pretty amazing thick intersections down the bottom, and you can see the pit goes down to 300 metres depth. It's 1 kilometre long by 800 metres wide, so it's a big open cut, but even that size is set to grow with all these new results. So I think we'll get a bigger pit. We'll take more ore out. It'll increase the economic numbers. At the same time, we'll be looking at underground development. Obviously not straight away, but it'll give you an idea on the scope of that in the future. In terms of the processing, there's a workforce of around 47, so in total about 130, assuming we're going into operation. And you can see some of the plants and the gravity circuits, etc. So that's quite an interesting little setup. ESG, something that we have to think about and action on. And what we're doing is, once we've mined Lady Julie Central, we'll put our tailings into that hole in the ground, and that will, save building other tailing dams in the area. We're trying to do a solar processing, mainly during the day, and not process it at night, to try to, do all the crushing during the day. And that's will save quite a bit of energy. And the third thing is the local people, so we'll be employing a lot of local groups in the area. The development timetable is a bit early stage, so it's not a real timetable as such, but it just gives you an idea if we were going into production. Remember, this is Plan B, so we're actioning Plan B and Plan A. Plan A is the M&A. Plan B is we're actioning as well, so we're doing both. And in summary, we've made a fantastic discovery. It's growing. The economic value is immense and set to grow again. We're looking at potential for stack loads, which we've never done before. Hopefully that happens as well. Potential for M&A is there. We've got these groups in their final due diligence positions. We're happy to keep drilling and uncovering as much ore in the meantime. So thank you very much.
Thank you very much, George. You've got 3 minutes up your sleeve. Did anyone ask him a question before you run out for lunch, or would you rather approach him at his booth?
I can do it.
What are you doing with Mr. Barden's glasses on down there? That's a bit of a worry. Someone's got Joe Barden's sunglasses on down here.
Okay.
Okay. All right, George, we'll come and see you out at the booth. Team, you've got an extra 3 minutes, thanks to the generosity of yours there. We've finished up in such a timely manner, and I will ring the bell when it's time to come back in. Please enjoy your lunch and check out what's happening with that nuclear debate now, and the Coalition has made their announcement as well. It's interesting. Thanks.